In order to understand the economic events transpiring in 1981, we must comprehend the rudiments of the financial securities world. The abstract being corporation operating within the United States receives legal authority from state and city governments to sell common shares in outright risk ventures, to which common shareholders they promise only a proportional sharing of cash profits from their economically successful operation. But corporations also receive legal authority to sell preferred stocks to the owners, of which the corporation becomes legally obliged to pay a fixed annual rate of interest before distributing any of the profit to those corporations' common stockholders. If, however, the corporation has no annual profit, it has no obligation to pay interest to preferred stockholders. Preferred means first to be paid off at a fixed annual percentum rate out of net earnings, after which fixed percentum payoff the common shareholders divide as much of the earned profits as the directors of the corporation feel can be distributed, while also taking care of new development expenses as well as safety factor reserve fund set-asides. If the corporate enterprise is to be liquidated, the preferred stockholders are to be paid off before the common stockholders. If the corporation fails, the preferred stockholders share in whatever equity may be left, but not so the common shareholders. If the corporation fails and no assets remain, the preferred stockholders have no further legal recourse, i.e., claiming rights. In addition to the common and preferred stocks, both of which are outright risk venture shares, corporations can raise initial working or expansion capital by issuing bonds, provided the corporation owns free and clear real wealth, that is, real estate or buildings, and easily saleable general machinery such as machine tools, lathes, drill presses, etc., with which machinists produce special-purpose mass production tools. The word real of real wealth, of reality, developed from the Spanish word for royal or royalty. The king or queen personally acknowledged truth. Real is what the socio-economic power structure decrees it is. Real is, like the abstract legal entity corporation, a legally accepted fiction. Real estate equals royal estate. Bonds are called securities, and their value is predicated upon the degree of probability that upon public liquidation of a company, the real estate buildings and machinery can be sold at the bond's face value or more. While corporate bonds have priority over preferred and common stocks when corporations are liquidated, fail, or are sold, the bonds do not have priority of claim over those to whom the corporation is already indebted for goods, services, etc., nor do the bonds have priority over federal, state, or municipal taxes. Bond owners have no share in the earnings of a corporation, but do have fixed interest priority over preferred stocks. It is relevant to our understanding of securities to note that bonds other than those of tax-guaranteed federal, state, county, and municipal bonds have often proven to be less than secure. For instance, approximately all the railroad company bonds of the USA were defaulted, i.e. became 100% unredeemable in the economic depression of 1929 to 1933 and thenceforth. Within the United States of North America, the right to incorporate is legally obtainable only from state governments and not from federal, nor city, town, or county governments. If, however, corporation promoters wish to sell shares worth more than $300,000 for capital expenditures before earnings, then the federal government's Securities and Exchange Commission must also give its approval. Some states in the United States grant incorporation rights that are more workingly satisfactory to a given type of enterprise than the privileges granted to the incorporators by other states. Some states' incorporation privileges are extended to cover the corporation's operations in other states. Many states grant incorporation privileges only within their own borders. In addition to the securities issued by corporations or by non-incorporated companies or partnerships, bonds are issued by towns, counties, cities, states, the federal government, and multi-state authorities. Federal, state, county, and city municipal bonds have faced declared maturity dates and clearly scheduled tax collection commitments to cover both the yearly interest rates and the maturity repayments to the bondholder. All such government bonds have prior right to funds produced by taxes. In the world of securities, properties represented by written documents that are legally recognized forms of negotiable monetary investments, there are also insurance policies, and in particular life insurance policies. Known in world history's earliest records as bottomry, what we now speak of as insurance dates back to its practice in 4000 BC Babylon as the underwriting of merchant ship voyages. This practice made it possible for wealthy individuals who are not shareholders in the original shipbuilding enterprise to participate at their own risk in the merchant ship venturing, which, when successful, was fabulously so. Historically, life insurance is a very recent form of the already wealthy humans and their corporations' capital gambling, and does not begin until the industrial era of the late 19th and early 20th century, when technology began to render humans' immediate physical environment more propitious for the protecting, support, and accommodation of increasing numbers of human individuals, despite remote devastations occurring in the world's wilderness areas. The technology of industrialization was first taken advantage of by the military, specifically intent on how to more accurately kill more and more people at ever great distances in ever shorter periods of time. As a consequence, the technologically advanced 19th century weaponry witnessed greatly increased war-wrought devastation, leaving more and more wounded to die on the battlefields. The medical world being as yet inexperienced and ignorant, the USA Civil War saw the highest ratio of deaths per battlefield committed soldiers in all history. Due to medical ignorance, the U.S. Civil War also saw more wounded left unattended to die on the battlefield than in all other wars of known history. When the USA entered World War I in 1917, it was asked by the British to replace all the line of supply ships the British had lost to German submarines, and simultaneously to bring the U.S. Navy to parity with that of the British, while also training, arming, transporting, and Navy escorting 1 million soldiers across the German submarine-infested Atlantic to the battlefields of France. When the numbers of USA troops killed and wounded in World War I battling reached unprecedented numbers, the U.S. Congress was confronted with the enormous cost of training, arming, and transatlantic replacing of their killed and wounded troops in France. The U.S. Congress was then informed of an alternative solution to the replacement problem. The U.S. medical scientists informed the U.S. Congress of the potential ability to save and repair the wounded U.S. soldiers in France, provided enough money was appropriated for a known to be possible vast advancement in medical science, drugs, equipment, and practice. The cost of this capital investment in medical science, though historically unprecedented, was far less than the cost of entirely new troop replacements from the U.S. Convinced of these facts, the U.S. Congress appropriated the funds for the medical science solution of its problem. It worked.